Are higher memory prices about to hit your phone and your portfolio? Goldman Sachs just cut its global smartphone outlook, and the reason goes straight to device costs and tech stocks. Here's the context. The smartphone market is exiting an inventory-led rebound and entering a cost-sensitive phase. DRAM and NAND prices are climbing faster than expected, which squeezes manufacturer margins and can slow shipment growth. Hardware cycles drive sentiment across tech, so this shift matters for equity positioning and sector allocation. The heart of the change is the memory upcycle. Supply is tighter and data center demand is stronger, so component costs per handset are moving up from late 2023 levels. At the same time, phones keep adding memory-hungry features. Mid to high-end models increasingly ship with 8 to 12 gigabytes of DRAM and 128 to 512 gigabytes of storage. That pushes memory to a larger share of the bill of materials and leaves less room to absorb price shocks. Pricing power is uneven across regions. Premium demand in some markets is steady, but price-sensitive segments in emerging economies are fragile. That limits the ability to pass higher costs through to consumers. Selective price increases, leaner specs, or even delayed refresh cycles become more likely. There's also less inventory cushion than in 2022 and 2023. Channel stocks have normalized, which reduces the buffer to protect margins without touching pricing or features. With roughly 1.17 billion smartphones shipped in 2023, even a small percentage cut in forecasts means tens of millions fewer units, with real revenue and utilization effects up and down the supply chain. The top 5 brands control about 80% of global shipments, so decisions by a handful of companies can quickly ripple to component suppliers. Meanwhile, a U.S. policy rate around 5.25 to 5.50% keeps financing costs elevated for inventories and consumer credit, amplifying sensitivity to device prices. For stocks, handset makers face margin pressure, with stronger vertically integrated brands better positioned. A mix shift toward premium tiers can help dollars, but it could intensify mid-range competition. Memory suppliers may see revenue and margin recovery on tighter supply, yet if handset orders slow, they'll lean more on server and AI demand to sustain pricing. Credit investors should watch weaker or subscale OEMs for refinancing and working capital strain into peak launches. Your practical takeaway: track DRAM and NAND pricing trends, average selling prices, and any signs of spec trimming or delayed launches from the top brands. Prioritize quality balance sheets and pricing power, and be cautious with over-levered mid-tier OEM exposure. Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.